Hi there traders, and welcome to this month's edition of the Keyzone Traders Trade of the Month. We're going to look at a trade that we took this month in Eurodollar. It was part of our expert alert service, and we're going to look at some, the reasons why we took it so that hopefully you can take some information away and start implementing that into your own trading as well. So with that being said, let's go jump into the charts. Hi there traders, so we're going to look at this trade that we took on Eurodollar earlier on in the month. This was part of our expert alert service where we give out the exact trade details of some of the trades that we're taking on our own account. I'm going to explain sort of like this basically is a textbook of how we look at the charts, how the type of trades that we're looking for. So that's why I'm going to use it as our trade of the month, and it works really nicely as well. So you can see here we were clearly in a downtrend on a euro dollar. This was a 15-minute chart, so we're clearly in a downtrend. This dark blue line, or this blue line here, is the 4-hour moving average, 20 moving average. Now I have that because when I'm looking at the 15-minute chart, the higher time frame context chart that I look at is the 4-hour, and this just tells me in a very quick and easy way that on the 4-hour chart we are also in a downtrend, because you can see the 4-hour moving average is moving downwards as well. So we've got this 15-minute downtrend, we've got a 4-hour downtrend as well, so we've got higher time frame context with this. Now we had this zone of support here. You can notice that we had held this zone as support here, first touch, held it a couple of times, and we broke through. Now notice when we retested it, we had resistance here, and we also had further resistance over here. So we now had an area where there had been clear liquidity, clear participation from both sides of the market in and around this zone, both as support, and then once we've broken through that support, we've now tested it a couple of times as resistance, and we've reacted from resistance. Now what generally happens when this happens is when the market knows there's liquidity in an area, the market will go hunting for that liquidity, and it will go and grab that liquidity, and that's exactly what it did here. It's basically what it's done is anyone who's short from anywhere in this area at all here will have their stop above this zone, because that would be where they would see price invalidated. So they would have there would be a load of stops in that just above this zone here. Equally, anyone who thinks that this, we've got a bit of a compression pattern here, a series of higher lows, so people will start to think maybe this is going to break out to the upside. So they will have their entries above this zone, as that is where they think that the market is going to turn and break out and push higher. So there's going to be a load of liquidity in this area. Now what generally happens is the market goes into that area and reverses. It stops people out, it gets people in who are trying to get in on the breakout, and then it just reverses to stop them out as well, to create liquidity, facilitate trades. And a lot of traders fall victim to this and create a victim mindset, thinking that the market is against them, when actually all the market is doing is completing the primary function of the market, of its existence, which is to create and facilitate trades. So what we do is we look for these areas of liquidity. We look for these where it's gone and taken that liquidity, and then puts in these signals. Notice how it goes, grabs that liquidity, turns and closes back inside that zone. Really strong close back inside that zone. So when we see that, we can enter a trade on a breakdown below that bar. We have our stop now above this candle, because if the market then goes and revisits above that, then it's a bit more of a sustained breakout. Because it's already grabbed that liquidity, so it doesn't need to go back and grab it again. It should have grabbed the liquidity that it needs, and it should now go and do what it wants to do. Now, generally speaking, you go for anything from a 1-to-1 to 2-to-1 target on this. For our service, I generally go for 1-to-1 targets, just because it's easier to manage. They're more set and forget. Sometimes I do go for 2-to-1 targets on these, but just on this instance, we actually took we just went for 1-to-1. And you can see we literally just triggered straight into the trade and pushed on down. You'll notice that, as I say, sometimes we can go for 2-to-1 targets, and it actually went and hit the 2-to-1 target very quickly as well. But we just went for a 1-to-1 target on this, and hopefully you can see that, A lot of people, when they're getting stocked out and getting entered into the markets, we're actually using that information to our advantage rather than creating that victim mindset. We're using that to our advantage and to actually profit from trade. So this was a really nice trade, really nice example, a textbook example of exactly the sort of trades that we're looking for, the exact sort of things and behaviours that we're looking in the market. So I hope you found it useful. If you would like to know more, please drop us a message, and I'd be happy to answer any questions that you have. But I hope you had a great month trading, and I'll speak to you soon. Cheers.